Well, howdy there, folks. Welcome into today's video. We have so much to get through in today's video. I got some points to make right off the top here, speaking to everybody that's a retail investor out there and kind of some emotions I'm seeing out there. We've got to talk about Amazon earnings, obviously super important stock for the market. We've got to speak about ENPH. ENPH stock is crashing. We've got to speak about that one. Is there an opportunity there now that stock has crashed pretty viciously? We got to talk about Texas Roadhouse in this video. Their earnings were reported. Google, Meta, obviously a lot of the tech stocks. It's a busy video. It's action-packed. I appreciate everybody joining me as always, folks. Thank you so much for being subscribed. And also, it's so busy right now that I'm trying to, basically, I can't talk about this subject today. I can't talk about this subject today because literally there's so many subjects I can speak about right now because there's so many earnings coming out and just different things out there that I'm actually cutting stuff out of videos right now in terms of just I'm not even going to bother prepping that because there's so much to talk about. And, yesterday's video was 41 minutes long. So I try to keep my videos 25 to 30 minutes on this channel. But yeah, right now it's a busy, busy time, folks. So thank you so much for being here as always. Okay. So where I actually want to start today's videos, public count, down huge again today, $39,000. This account's been pounded this last, I would say, about a week and a half. You go back a week and a half ago, this was probably a I think it was a $1.77 million portfolio. So we've been hit about $200,000 in a matter of, let's call it a week and a half, maybe 2 weeks here. Just an absolute vicious pounding of the public account here, right? And honestly, the only things that are going right in the public account, in the past week and a half, 2 weeks, it's the put options, it's the hedges. That's the only thing that's going right. Outside of that, it's just everything's down and out, right? My Tesla puts are looking great. My Polaris puts are looking phenomenal. My Toll Brother puts are looking great. My Chipotle earnings that just made me think Chipotle earnings came out after the bell. We're not even going to get to Chipotle earnings in this video. That's just one of many things I had to cut because we have so many things to get through, right? But in terms of the hedges, obviously this is their moment to shine when the market's getting really tough, like it is obviously right now, right? And I've been noticing a sentiment out there that I need to speak about, and it's coming from, I think, a lot of the newer retail investors. They have a very sour taste in their mouth right now, very sour taste in their mouth, and they're very frustrated with the state of the market right now. Very frustrated. And I can understand it, okay? Because here we are with S&P 500 down about 9.4% in the past 4 months. Now, first thing I want to say that I think is very important, that everybody understands this. Listen, these type of drops in S&P 500 are very normal. Almost every single year I can ever remember being in the stock market the past 15 years, we get a 5 to 10% drop at some point in the year for the S&P 500. It usually happens in a matter of a few months. So when you see a move like this, just understand this isn't unprecedented. This isn't oh my gosh, I can't believe this is happening. This never happens. It happens almost every year, okay? So that's the first thing I want to bring up. But I don't think this is actually the thing that's bothering a lot of people, with the NASDAQ being down 10+% in the past 3 months, S&P 500 down 9+%, right? I think the number one thing that's bugging newer investors right now is to see the earnings reports that are coming out of some of these companies, right? The Meta report, the Google report, the Microsoft report. And what happens with those stocks? They all lose all their value, right? In terms of if they gained anything recently, they lost it all. And the stocks actually got beaten down. And people are looking at that and they're like, what? How can a company beat earnings, EPS? How can they beat revenue? How can they have a good guidance? How can they have all these good numbers? The valuation doesn't even seem high and the stocks go down, right? And it's bugging a lot of people. And I can understand, especially because I went through this very hard. When I first moved to Vegas, I lived in this little apartment right here, okay? It was a 3-bedroom apartment in Henderson. And I had this extra bedroom, and so I set it up into an office. And I had a flat screen TV there. I would have CNBC on all day, and I had my iPad set up, and I have all my stuff set up. And basically, I started getting into trading stocks, and I started doing some swing trades. And that's when I really noticed how frustrating the market can be if you're trying to play this off of short-term results. Because I never really paid attention to it, because prior to that, I worked at Quick Trip, so I had a full-time job. So investing was kind of like my side piece that I got to, after I got done work, I'd listen to a conference call or keep up with the market or, read an annual report. And in 2015, a lot of things changed, and I wasn't doing anything for work at that time. And so I was just focused on the markets, and I would do these earnings trades that were crazy. I'd do these earnings trades of $30,000, $50,000, $100,000 on a swing trade, essentially, because I was like, I believe this company's going to report good number, good number, good number. And a lot of times I was right. Actually, most of the time I was right about the numbers. But many times the stock price went down substantially still. And so the next day, all of a sudden I wake up and I lost $5,000, $10,000. And believe me, back in those days, I didn't have that sort of money to be losing $5,000, $10,000 on a freaking trade, okay? You look at me today, I don't even play earnings trades from some, you don't see me just throwing $50,000 on a stock on an earnings trade, $100,000, and I have way more money. It's not even close compared to my net worth today versus back then. I was doing stupid stuff, and it started to stress me out. And so I understand what people are going through if you're getting stressed out over the short-term stuff. And I think a lot of it comes back to, are you playing options short-term? Do you need this money right now? And those sorts of things, because I think if you need the money now, it's going to frustrate a lot of people. King Digital, I had this company down so perfect when it came to their earnings per share and exactly what they were going to report. It was sickening. It was sickening. I could forecast this company's earnings better than their CFO could forecast them, okay? And I would play this one for earnings trades and lose out. And I just remember, I remember losing $10,000 plus in a day on King, and just being like, what? I was right on. How is this one going down? And I had this whole way of forecasting their numbers based upon where their gains were at, and I was right on. But then they would sandbag guidance, and then the stock would go down. And I'm like, are you kidding me, man? Okay, listen. If you are playing this market from a short-term perspective, it is a very dangerous thing, and it's going to lead you to a lot of frustration. A lot of frustration. By the way, it's crazy because King actually got bought out by Activision Blizzard, right? This is back in 2016 for $5.9 billion. And now Activision Blizzard is actually owned by Microsoft. And so this comes full circle because recently I'm actually starting to consider buying Microsoft stock. I haven't bought it yet, but it's something I am considering based upon the earnings. I see Microsoft put up quarter in and quarter out. I'm like, dang, man. I wonder if I should buy a little Mr. Softy here. So that's a stock market for you. So bottom line is, folks, don't get too much of a sour taste in your mouth. Market drops 5-10% in the S&P 500. Very normal. You're going to have some crashes some years where the S&P 500 goes down 20, 30, 40%. And that's the way it is. And other than that, companies are going to report great earnings and sometimes their stocks are going to go down. That's what creates arbitrage in the market. Don't get frustrated by it, okay? Alrighty. Now to speak about Amazon. Obviously, this is a big subject of the day, right? Certainly a big position for me in the public count. That should be my third biggest position in the public count, about $125,000 rolling into these earnings in the public count for Amazon, okay? First off, they had a crazy beat on their EPS. They reported 94 cents. I told you guys they were going to smash it. They smashed it more than I thought they were going to smash it, to be honest. That's a crazy number. 94 cents in what I saw, most analysts were kind of in the 50 to 60 cent range for their EPS estimates. So just a shocking beat. They also beat on revenue by about $1.5 billion or so. So incredible beats right off the bat, right? Now, if we look at net sales, they went from $127 billion in net sales in the same quarter last year to $143 billion in net sales in this current quarter we're in for Amazon. That's incredible, folks. Just think about that. They had $16 billion like it was nothing. Up 13% year over year. If we look at operating income, this is one of the most impressive slides you'll ever see. Operating income was up 343% year over year. They went from $2.5 billion of operating income in the same quarter last year to $11.1 billion of operating income, right? And I think a lot of people can see why I was so happy to be a buyer of the stock very aggressively and why I said I got to add the stock aggressively, because I had a feeling they were going to flip their profitability in an immense way. And I'll be honest, they're even beating my expectations in regards to this. Their net income went from $2.8 billion in the same quarter last year to $9.8 billion. That's up 244% just on a year-over-year basis, folks. These are incredible numbers. Now, North America went from actually the same quarter last year, they actually lost money in North America segment, right? They just brought in $4.3 billion of operating income. Now, this is the best slide for me. This is the biggest and best slide for me. This matters more than anything else for me personally when it comes to this earnings, okay? Not for Wall Street, but for me. If you're just listening to this video, look at this slide in front of you right now, okay? Listen, operating loss in the same quarter last year for the international segment was around $2.5 billion. They just took a $95 million loss in this quarter they just reported, which means the international business is about to flip from huge losses to actual profitability. And that's such a big turn. That's such a big turn for a company overall when you have a segment that's dragging you down like that, right? And then you just lift those weights off you and they're off your shoulders and you've got that's not there anymore. And actually, let's say it is now a tailwind behind you. It's incredible. It's absolutely incredible. And that's what's going on with Amazon's business model. So this was, to me, was everything. This international slide. Most people weren't even paying attention to this. And I'm like, guys, I know you guys are so, all these Wall Streeters are so like, Amazon Web Services, Amazon Web Services, Amazon Web Services. I understand. But I wish they would just look a little bigger picture sometimes, because a slide like this is everything. It's everything, okay? Now, speaking about AWS, right? Obviously, always been the cash cow of Amazon and continues to be. Operating income went from $5.4 billion in the same quarter last year to almost $7 billion in operating income they just put up with AWS. And they reported 12% year-over-year sales growth, which is definitely headed back in the right direction when it comes to Amazon here. Free cash flow, this is on a trailing 12-month basis. At this time last year, they were at about almost a $20 billion negative free cash flow. Now, trailing 12-month, they're at positive $21 billion. What a change, right? If we look at their overall income statement, folks, this is an A-plus income statement. If you want to take a picture of an A-plus income statement, take a picture of Amazon's income statement right here. That's an A-plus. That's what, like, if you ever want to compare, how's my company doing versus that quarter that Jeremy called with was an A-plus. There you go, okay? That's an A-plus. Net product sales, $63 billion versus $59 billion, same quarter last year. Net service sales, $79 billion versus $67 the same quarter last year. Obviously, total net sales, $127 billion was this time last year, $143 billion they just did. Cost of sales was in line with what you expect. Fulfillment, they kept that in line. Technology and infrastructure, they kept that in line. Sales and marketing, they actually were able to drop that number year over year. When you can grow your revenue $16 billion roughly, and you can drop your sales and marketing and your general and administrative, it's the holy grail. Like, you got to be flipping my flapjacks. They kept operating expenses in check in such a major way. Operating expenses only went up around a little over $7 billion, but net sales went up over $16 billion. That's where the magic's at, folks. That's where the magic at. And so if you want to know why did the operating income go up like that, it's math, okay? It's mathematics, very simple math. That's why operating income went from $2.5 billion in the same quarter last year to over $11 billion in this quarter they just reported. Also, interest income, interest expense kind of cancel each other out there. Other income, they did have a little positive gain. I believe that was because of Rivian stock in this past quarter, although Rivian has weakened recently, so that could be a little bit of a drag for next quarter. We'll see what happens there. Income before income taxes, over $12 billion in income before income taxes versus less than $3 billion in the same quarter last year. Jeez. Net income, nearly $10 billion for the company versus $2.8 in the same quarter last year. And diluted EPS, 94 cents versus 28 cents in the same quarter last year. Man, if that wasn't good enough, look at the balance sheet. $486 billion in total assets now on the balance sheet, $49 billion plus in cash and cash equivalents, and another $14 billion plus in marketable securities. Now, let's talk about the stock price and what happened, okay? So, the stock price after the initial earnings came out blasted higher. And then it plummeted down. And basically, right around the time the conference call started and was just starting to run, the stock actually hit a low in after hours. And then it came flying back up. So what did Jassy say on the conference call that was so big? I'll tell you what he said, okay? And if you were on my Twitch live stream today, you know what he said. Basically, the gist of it is Andy Jassy, CEO of Amazon, basically called a bottom on AWS. Without saying this is the bottom and things are just going to get better. If you listen to, they asked him a million different ways about AWS on the call. And if you read through what that man said, basically it sounds like 24, 25 are going to be looking really good for us in regards to AWS. And it sounds like there was a lot of companies that basically, if you don't know the story on AWS the past 12 to 18 months, basically there was a lot of companies that had been watching their costs in a substantial way. And so all these companies pulled back and they wanted to spend less and less in AWS, and AWS helped them do that, right? And so they cut back on this, they cut back on that. Well, none of these companies and a lot of these businesses are pretty much to a stage or getting close to a stage where they don't really have much more cost savings they can do when it comes to AWS. That's about it. And so now AWS is in a very strong position where people are, a lot of these companies are getting a little more focused on growth, AI moving forward, right? Which is a huge benefit to Amazon. And they're getting out of this whole, I can call it scarcity mentality, right? Just as an individual like us, we can get into scarcity mentality. We can be in abundance mentality. Well, for the last year or so, a lot of these companies were in a very much scarcity mentality, right? How do we save as much as possible? Save, cost savings. Now it looks like going into 24, people are much more focused on expansion. How do we expand our business? How do we, grow bigger and bigger rather than contraction? Okay, and that's a whole different mindset. And it happens in organizations, it happens in companies, and it's healthy. So, if you're always in scarcity mentality, that's horrible. You're going to go bankrupt, okay? You'll go out of business. If you're always in abundance mentality, that's also not healthy, okay? You end up being a Zuckerberg, just spending like crazy on the metaverse, right? So you don't want to necessarily be in any of those categories. You want to be more on the abundance side as a company or an individual. But every once in a while, you kind of got to join the scarcity side for just a bit to kind of watch everything that's going on there. And so that's kind of where I would place, a lot of AWS customers over this past year or so. So I thought that was big. So overall thoughts on Amazon as a shareholder of the company, okay? E-commerce is strong. It looks, the whole goods recession that we've kind of been in looks like it's come to an end now at this point in time. And based upon these earnings I'm starting to see, based upon Meta's numbers, Google's numbers, based upon Amazon's numbers, it looks like the goods recession is over. And it looks like we have come out of that now. And it looks like, if anything, we're getting back into growth mode. And I think it's actually going to be a pretty decent Christmas out there. Profitability is explosive at Amazon, and I think the profits are going to continue to skyrocket here in the next few quarters, and then we'll probably level out for a bit. International flipping from massive, epic, multi-billion-dollar losses in a quarter to now getting probably to profitability or something very close to profitability is massive. I love that. AWS looks bright for 24 and 25. Costs are in control, very in control when it comes to Amazon, the most in control I've seen. Advertising is strong on Amazon. They continue to be an advertising growth beast. And Jesse's a big boss man, and he's running the show, and he's running the show damn good. So overall, could I be any happier in regards to Amazon earnings? I really couldn't. This was it. Like, the conference call was amazing. It was probably the best conference call so far I've listened to this earnings season. And damn, man. Those numbers were incredible. Absolutely incredible. Alrighty, next up here, ENPH. So ENPH stock is crashing. Remember, folks, ENPH stock was $300 plus at this time last year. ENPH stock after hours is $80. There's a potential that ENPH could be in the 70s tomorrow during the trading day. Yes, the 70s. And once again, at this time last year, ENPH was a $300 plus stock. All right. So ENPH down massively after hours. What's going on here? Well, they have two major problems. This is problem number one. Problem number one with ENPH is, if you look at a sequential basis, their revenues are starting to drop. By the way, they missed analyst expectations from what I saw on revenue in general, which is not good. But also, look at this. In Q2, they did $711 million in revenue, and that just dropped down to $551, right? Even worse, operating income went from $170 million in Q2 2023, which is the last quarter, right, to this quarter, $117 million. Talk about a drop. Net income went from $157 million to $113 million. Diluted EPS went from $1.09 to 80 cents. All right. So clear massive deceleration is going on in ENPH. But that's not the worst part. Okay. And remember, SolarEdge already kind of prepped a lot of people in regards to what ENPH numbers are likely look at. When ENPH reported what they reported, a lot of people are like, oh, okay, things are pretty bad here. But there was a hope that things aren't quite as bad with ENPH because ENPH maybe isn't as exposed to the European market as somebody like a SolarEdge was. That was at least a belief, and that's what a lot of bulls were kind of talking about, right? Folks, this is so much of a disaster in regards to what's going on with ENPH. It's hard to even explain this. I'm just going to show you the numbers, okay? Here's what's going on. This is a way bigger problem with ENPH right now, okay? ENPH was supposed to do $566 million in this current quarter, right? And then they were supposed to do $576 million in next quarter, the December quarter, right? Which, keep in mind, that was going to be down 21% as it was. So, folks, they were going to report a horrible revenue quarter was expected from ENPH. 571. Keep that number in your mind. 25 analysts had numbers. 571 is what analysts were expecting. 21% drop. ENPH just said, you guys aren't even close. We're going to report way worse. Look at this. It's game over. ENPH said the revenue for this upcoming quarter is going to be between $300 and $350 million. That's a $325 million midpoint. Folks, $571 million was the average expectation, the average estimate. The fact that the company says they're going to do 325 at the midpoint, I don't know what to say. It doesn't get worse than that. I've been in the stock market 15 years, folks. I don't know if I've ever seen a revenue guide that big of a miss from a company that's fairly popular, which ENPH is a fairly popular stock. Unbelievably shocking. It's one thing to miss numbers. It's one thing to, we missed by 5%, 10%, whatever. It's another to do what ENPH just did. That's a whole different ball game there, folks, okay? My gosh. And that goes back to what I was trying to tell people about and warn people about, right? I've talked about ENPH last, several days on the channel. And I said, you got to be careful with ENPH because it might look cheap. The stock might not be cheap at all. And sure enough, is exactly what played out. People saw ENPH trading at 20 times this year's numbers or whatever and saying, oh man, stock's so cheap. Because ENPH never trades at that sort of valuation. Well, here's the problem. ENPH is likely going to lose money the next few quarters. Not make profits, lose money. Become unprofitable for at least the next few quarters. And then hopefully gain it back at some point in time. So when you're looking at these analyst expectations, just keep in mind, they're about to get slaughtered by analysts. Every analyst out there is going to cut their estimates in an epic way. And they're going to continue to cut and downgrade ENPH's stock. And so now it's got to go through that brutal cycle. But folks, the 491 that was expected for this year, that's not happening. The 614 that was expected for next year, that's not happening, okay? So although it looked cheap, it was actually just a trap. It was actually just a trap in the end. And so now, I will give everybody at least a little good news in regards to ENPH, because there's a little sliver of good news in regards to this ENPH story outside of just its balance sheet and its long-term track record. There's a little piece of good news, okay? So on the Twitch live stream today, I heard, we went through a bunch of things. Obviously, all the earnings that came out. We were listening to the ENPH call. We listened to the entire Amazon call. But we listened to the ENPH call, and there was some good news that came out on that. And basically, what it sounds like is it sounds to me, based upon what I heard the executive say, is it sounds like in the second quarter or third quarter, inventory should bottom. Now that's big and that's impactful, so that likely means the business model bottoms probably in the next 2 to 3 quarters. So that's great news. But don't get too excited about that. Don't get your hopes up too much, folks, because it still has to play out, right? It still has to play out. But if you want a sliver of good news, maybe we're 2 to 3 quarters away from the bottom in regards to ENPH. But in between that time and the next time, like the stock could get brutalized. We don't know what long-term profitability will be. Even when the business, that's a problem. Even when the business bottoms, let's say it bottoms in the second quarter of the year, right? Let's say that's the peak bottom for the business. Well, we don't know what the profitability model is going to be looking like for ENPH moving forward. That's the problem, folks. We don't know. We don't even have a clue. Like anybody that tries to say ENPH is going to earn this in 2024, no, you're literally just throwing out a guess. There's not a person on this planet, including the CFO of the company, that could tell me what ENPH's EPS will be next year. Not a person. It's one of those situations, folks. When you have this bad of a situation, it's ugly, and that's what's going on here. Okay. Now, I have seen this. I don't know if you guys saw, Whirlpool stock dropped nearly 16% here today. 16 percentage points. RH stock was down nearly 5 percentage points. RH is flirting with going under 200. Now, these are two stocks I'm looking at very heavily for adding. I don't know if I'll add them this quarter because there's a lot of other opportunities out there, but I can definitely see myself adding them in the first quarter of 2024. And you might say, why would I want to get in a Whirlpool? Why would I want to get in RH and start positioning into those? Okay, here's what I'm looking at for housing. Housing, in my opinion, is likely going to bottom in the next 3 to 9 months when it comes to the amount of home sales. Basically, we've been plummeting down for existing home sales for the last several years, right? And it's just gotten worse and worse and worse, and I think it's going to get worse before it gets better. But with that being said, I think there's an extremely high probability we bottom out existing home sales within the next 1 to 3 quarters, which means essentially if I want to get into a play like a Whirlpool, which is more of a play on the masses moving, right? Or a play like an RH, I've got to kind of get building those positions in the first 6 months of 2024 while things are in that bottoming out process. Because I do believe in the second half of 2024, I do believe we can actually start to see existing home sales go up. And I believe in 2025, you'll see existing home sales go up quite substantially. And kind of, things will then start to normalize after 2025. But that's kind of why I'm thinking I've got to position into those ones really the first half of the year. And so for now, I hope those stocks just continue to get brutalized there for a bit of time. And, you ask me which one I like more. It just depends. I mean, RH plays in the high end. They're catering to rich people, right? And they're catering to luxury homes being sold, luxury apartments being sold. Whirlpool's catering to the masses, so they compete differently. But I like them both starting in the first half of 2024 as far as me building out a position and getting ready for those ones to start to roll in the second half of 2024 and then certainly into 2025 when I think home sales will be back in a much healthier place, okay? Now, you guys have seen how these tech stocks are getting slaughtered, right? Here's what I'll tell you guys, what's actually going on here. Wall Street's looking for a reason to exit a lot of these stocks. They're looking for a reason to take their profits. There's been a lot of money to be made in a lot of these tech stocks this year. And here's the deal, okay? On a 6-month treasury right now, you can get 5.56%. I think a lot of these Wall Streeters are like, give me a reason. Give me any reason. I don't care what it is to sell my whatever stock, my Google, my Meta, whatever, my NVIDIA. They'll look for any reason right now. You could come in and report great revenue, great EPS, great guidance, whatever. It really doesn't matter. They're just, at the end of the day, folks, they just want to sell. And if they just want to sell, they just want to sell. It is what it is, right? And I do worry a little bit that, think about it this way, okay? If you made a lot of money in tech stocks and you're taking big profits, well, suddenly you want to offset those somehow, right? Or do you want to pay your taxes? Of course you don't want to pay your taxes. So if you have some losing stocks, some, let's call it loser stocks, you're going to sell those off over this next couple months to basically offset your gains, right? A little tax loss harvesting. And then you'll go and you'll buy those stocks back in the first quarter, second quarter of 2024. So if people are taking some profits, a lot of these Wall Streeters are taking profits out of these tech stocks, they're likely going to want to offset it. So which means you're going to still see more tax loss harvesting this year in a lot of the dividend stocks, a lot of the value stocks, and maybe even in some of these stocks like the Whirlpools, the RHs that have been loser stocks this year and just, not been there, right? Many of those stocks, in a lot of those safety stocks I bring up to your guys' attention all the time, many of those stocks, folks, could continue to see relentless selling pressure actually in November and December, regardless of Santa Claus rally. So there's just one thing to kind of keep in mind here, folks. The more people that want to take profits out of techs, by the way, the more you'll see tax loss harvesting. So let that sink in for a moment, right? Now, Texas Roadhouse, one of the most well-run companies in the entire stock market, just reported a very bad quarter, folks. Very bad. This is a C- quarter. Shocking. So Texas Roadhouse's revenue was very good, $1.1 billion versus $993 the same quarter last year, right? Food and beverage went up, but if your revenue is going to go up like that, you expect food and beverage to be up. But they're getting hit hard with labor. Look how much labor went up. $378 million in labor costs versus $330 in the same quarter last year. Also, other operating expense went to $169 million versus $146 million same quarter last year. And general and administrative went up, let's call it about $5 million roughly. So the total costs and expenses went up immensely. And so their income from operations, despite growing their revenue so immensely, their income from operations went down year over year. That's inexcusable for the Roadhouse. Now, the great thing is for the Roadhouse, they have one of the best balance sheets, certainly in the restaurant category, if not the best. And so they're able to make interest income. So that helps the income before taxes, and that obviously helps net income in their EPS. So they had slight growth there. But anytime you're growing your revenue very strong, like Roadhouse just did with about, let's call it a 12% type number, and your operating income drops, that means you're mismanaging your business, or you have certain things going on that just are working against you in a massive way. And it seems like for Roadhouse, it could be a partial of food cost inflation, and it could be labor, right? So I thought that was just a bad earnings from Texas Roadhouse, which they don't ever. I mean, Texas Roadhouse is one of those companies. B's and A's is what they usually report for quarters, and this was a C minus, so bad quarter. Now we're getting close to halftime on this earnings season. How am I feeling so far? Right? I'll say this. I would say if I had to grade this earnings season so far with what we've seen, we're at about a B plus right now. And by the way, halftime of this earnings season basically starts next week. You know, probably Tuesday will be about halfway through earnings season in terms of a lot of the big companies to report. I give it a B plus. I've been really happy with a lot of the big tech stocks that had horrible years last year, did a lot of cost cutting measures, and now got their businesses in a great place for profitability and operating income, right? On the flip side, I'm seeing some of these other companies like a Texas Roadhouse really disappoint. I'm seeing a Whirlpool report bad numbers, which doesn't come as a surprise. We understand what's going on there, right? And I'm seeing some other troubling numbers from some of these other companies that had been reporting really good numbers. So that's why I can't give it an A grade. It's a B plus. I'll give it a B plus, right? If you look at just Meta, Google, and Amazon and Microsoft, we'd be at an A plus, just to be honest. But there's more companies than just those a few magnificent, whatever we want to call them, okay? So I thought that was important. Will I be buying stocks tomorrow? The answer to that is absolutely. Yes, I will be buying stocks tomorrow. And if you want to see what stocks I am buying tomorrow, then check out the pinned comment down there. And you can join my Patreon. And they got a tier where you can see all the moves I'm making, exactly how I build up the portfolio. And then I have another tier where you can see all that. Plus, you get access to my Becoming Master of the Stock Market course, which is like a $997 value. So yeah, if you are interested in either one of those tiers and to see the moves I'm making each week, then join my Patreon, pin comment down there. Much love as always, folks, and have a great day.